Welcome back to another video. Welcome back to World TFX Academy. Today we are covering stop losses like last time, but this time around we're covering stop losses after you take a sale. We're going to take some setup straight from the book that is available to you now on Amazon. All you have to do is type in World TFX Academy, get this book, hands on, everything that you need to understand when it comes to stop loss placements, everything you will need to make sure your stop loss does not get hit the way it's supposed to be. Um, without with that being said, let's just go ahead and get into it. All right, so let's get into this. First thing first, if you watched the previous video when I went over stop losses for buy market, I did went over this setup that I was waiting for the buy. It's a GJ, GBP, JPY. We are in the 4-hour time frame. We was waiting for that bullish engulf, and we have a 3-candle price action where it took 2 bullish candles to engulf the last bearish candle. As you can see right here was my entry, right? And market did go my way. The market bought for 12 hours. I kept my stop loss where it was supposed to be the last low if we're comparing it to the left. You see it went my way, but eventually it did shoot straight down to go right back up. But because my stop loss was placed correctly, it never got stopped out. So as you can see, I'm still in the trade. And as you can see, market is now looking like it's about to go back up like it's supposed to. But of course, this time around, I would definitely be transitioning the stop loss to place it in profit because we're about to hit our midweek reversal. Okay, so with that being said, let's go ahead and get into it. Stop loss placement straight from the book, available to you now on Amazon. All right, so stop loss placement. So we're looking for stop losses, how to place them, where to place them, especially for a selling market after you take a sale. Okay, stop loss after a sale, right? It must be placed at the last high. Okay, so very simple, small little structure real quick, right? A downtrend market giving you lower lows and lower high. When you get a break and retest like so, that's the retest point. When you enter here for your sell, this is your previous high. Okay. So we're going to do a quick little one again after that. That way we understand. So when the market gives you a double top setup where we got one high and then we got a second high like so, right? So let's just say the last bearish candle looked like so with a wick high like this. And then we get our bearish candle price action within here. When we enter here for a sell, we place in our stop loss on top of the last high. Okay. I want to make sure we understand that. So that's what we're about to cover today. Okay. So, but like before, we want to go over our rules when it comes to trading the market itself. Okay. So let's get into it. So when it comes to trading the market, either if you are buying it or selling it, regardless of what the setup is. But what you want to do is make sure you have these 4 rules available to you at all time. Okay. Rule number 1 is time frame as far as for technical analysis. The time frame you're looking for these double bottoms, these double tops, these break and retests for the buys and for these sales. Okay. So your technical analysis itself has to be based off the month or the week or the daily time frame. Okay, so we are trading the bigger picture. We're looking at what the market is giving us in the bigger picture. Where is it going for the day? Where is it going for the week? Where is it going for the month? So it could be one with the market. Now, rule number 2 is what time frame are we using to execute? The time frame you're going to use to actually enter in your trade. And that time frame is going to be the H4. The H4 is your 4-hour time frame. Okay. Very simple. We're not dropping to anything lower than that, the 4-hour time frame. Now, rule number 2 goes hand to hand with rule number 3, because rule number 3 is the reason why you pull in the trigger, right? Price action itself. The price action we're going to be using is the engulfing bar. Okay. The engulfing bar. To be more specific, it will be the bearish. Okay. It will be the bearish. Okay. engulfing bar. So that's the selling candle we're looking at. Okay. So just to go over that real quick, a bearish engulfing is exactly what it means when you think of the word engulfing. Okay. So buyers was in control, the market was going up, and then eventually sellers, aka the bears, sellers take over. Now, how they take over is based on the market when it comes to technical analysis, when it comes to the candle itself, price. Okay. Price is at a specific level where the market will, let me show you this real quick. We're going to have a market that's going up like so. Boom, it hit a point. At that point, this right here was the last selling candle. Okay. Now, let me make this right here. I'm sorry. This was the last buying candle. I'm so sorry. These are buying candles. Okay. They're going up. This was the last buying candles. Eventually, sellers take over where you get a candle that engulf, that is bigger, that overtake the last buying candle, right? Overtake, to engulf. So that's a bearish engulfing. All right. So that book itself, The Ultimate Price Action, is also available to you on Amazon. Okay. Everything that you need to understand about price action, about 5 to 6 different variation of price action that the market will give you. Guarantee it will give you one of them before you either sell or buy. In this case, before it sells. So that's number 3, price action, right? The reason why we pull in the trigger when price is at a specific level, the candle is bigger than the previous one, saying that, hey, sellers are not in control. It is now time to take action. Okay. That is your price action. Now, number 4, rule number 4 goes with structure itself. Okay. That's why we use the 4-hour for our time frame also, because we're looking at the next previous structure. So just like before, you see, like we did the double top aspect, right? Like so. If we enter here for a sell, we're looking at the previous high to push a stop loss, right? So when we get a break and retest, market breaks, retest like so, right? It retests. Here, we take our trade and then we place our stop loss at the last high. Okay, so rule 1, 2, 3, 4. So rule number 1, higher time frame, monthly, weekly, daily. Only time frame you should be using for your technical analysis. Done. Rule number 2, time frame that you are using to actually execute, to pull the trigger, to enter for a buy, to enter for a sell, to short the market, to go long. Okay, that's rule number 2, 4-hour time frame. Rule number 3, price action. Okay, where price is actually at a certain level and it's telling you, hey, it is now time to take action, and that price action will be the engulfing bar. To be more specific, the bearish engulfing bar, right? Rule number 4, the most, if not last, very important one, your stop loss placement. Okay. Your stop loss always go at the last high when you're taking a sell. Of course, it goes at the last low when you are buying the market. Remember, you placing the stop loss where it needs to be. No fear, no FOMO, no hoping. All right. No emotion involved, to be exact. Okay. You're gonna have that under control for the most part. Okay. As long as you're not over leveraging, you should be just fine. So that's all rules. So every time we're about to enter a trade, we want to make sure we have these 4 rules locked in. That way you have nothing to worry about. Right. A perfect example of that, really, just like I just showed you, would be, the GJ 4-hour bullish engulfing that I took. I took that yesterday, right? I took that yesterday at 1 p.m. All right. Right now it's about like 8:30 p.m. Okay, so it's like a whole 24-hour already passed. And I'm still good. Yes, market shot straight down. Okay. But before it did go my way. X amount of pips, if I remember correctly, about like $275, if I remember correctly, with a $4 lot size. Okay. All right. So it's not about the money. It's just as long as you're not over leveraging, you got the account to manage your stop loss. Okay. So let's get into it. So we're gonna go ahead and look at setup number 1. Okay. All right. So setup number 1 is textbook. Okay. Now I want to make sure this is very clear. Okay. This setup itself is based off the higher time frame. Okay, I'm going to repeat that over and over. The setup itself is based off the higher time frame, either the monthly time frame, the weekly time frame, or the daily time frame. Now, when you drop down to the 4 hour, it will look pretty much identical to the same type of setup. Okay. Now, this is what we're looking at, right? So we had a market that was buying up. Okay. We have a market that was buying up. Okay. And it hit a specific area, and then it give us a bearish engulfing price action. To be more specific, this is a two bearish candle price action. I like to call this a 3 candle price action. Why? Because it took two bearish candle to engulf the last bullish candle, as you can see. Let me minimize this real quick. All right, as you can see, boom, right? So it took two 4 hour candles to engulf the last bearish candle. Here would be your entry, and we would use the wick high for a stop loss. Okay, now market give us a price action and it sold. Very simple, right? It went down because it gave us a price action and sold. We're gonna mark this level here. Okay, that's our zone. We just generate a zone. We just put a line, a horizontal line straight across. All right. No specific name for it. We just place a top zone at that area for winning if. Okay. For winning if market gets back to that zone, as you can see. All right. Once market gets back to the zone, we're going to look to the left. Okay. We look to the left to see what did the market did before, right? We look at the past. Okay. So we always look at the past so we can have a better future, a more productive future. Okay. So we understand what happened in the past so we could have a better understanding of how to move forward, right? Knowing is one thing. Understanding allow you to interact and react accordingly. Okay. So what we look at is what did the market did last time before it fell, right? It gave us a 3 candle price action where it took two bearish candles to engulf. So when market give us the engulfing bar, sometimes it might take one. Okay. Remember, we have about 5 different variations of it, right? Sometimes it might take one, but in the case of this one, it gave us exactly the same thing, right? Where these right here was about equal, right? Here is the last bearish candle. That's where it closed at. Right here, okay? Right here would be your entry, okay? Once you enter here for your sell, okay? Once you enter here for a sell, so you're going short, right? You're gonna look to the left like last time to look for a previous high so you can place your stop loss. All right. Now, in the case of this, you don't have any high that's higher than the wick of the previous of the first bearish candle. Sometimes it could be the last bullish. So what we're gonna do is we're gonna use the wick of this right here to place our stop loss. Okay. So your entry and your stop loss is placed at the last high, straight to the point, nothing crazy, nothing too difficult, nothing to over think about, nothing to overcomplicate. Okay, straight to the point. So let's go ahead and move on to the next setup that we're gonna look at. And also, of course, previous structure points, as you can see here, bullish engulfing. I know I didn't place the zone, but here it is. So when you take this sell, of course, you target the next low, right? Or the next structure below. Now, normally when you take this sell, you transition to the higher time frame, the monthly time frame, so you could have the proper TP target. Remember, the setup itself is based off either the monthly, the weekly, or the daily. Okay. So once you pull the trigger in the 4 hour time frame, taking your 4 hour bullish or bear in this case bearish engulfing, you want to go back to the higher time frame to target your proper TP. Okay. So take profit. All right. So here goes a different variation of a double top. Now, with this variation of this double top, right, it's slightly a bit different. When market gets to the zone itself, it consolidate. Okay. Now, before we get to that point, so like before, we had a market that was going up. to give you this double top. Okay. Sometimes we could flip that around actually. You know what? Let's flip it around. We could just say that we had a market that was selling. Okay. It was selling, and then boom. This is the retest that we get. So market fell, giving us a lower low point here. Okay. And then it give us a low high, and then it give us another lower low. So in the case of this, we'll be looking at the break and the retest, right? So what we're looking at is market itself broke the previous low right here, right? So let's throw that with red real quick. Let's find it out, make it a bit thinner, right? So right here, right, it broke through it. It broke through it and goes straight down. Boom. So just like before, the previous low high, that's where the market stopped at and turn around. In the case of this, we have the single bar price action where it only took one bearish candle to engulf the last bullish candle. And market went and break the previous lower low to go and give you a new low point. Now, when market come back to retest, as you can see, it came back to retest this point here, right? It broke above it. It consolidate here, see that? Consolidate and then continue up, right? Now, the zone is up there. So we do have that zone here. We didn't get no price action here for the continuation down. Instead, market continue up to give you a double top, okay? Call that DT a double top, okay? So that's when the market went up, stop, okay? Goes down, goes right back up to the same area. That's the second time. Now, again, we are doing exactly the same thing that we did last time, okay? We marked the zone because market fell, plain and simple, right? When the market comes back to that zone, we want to look to the left. Again, we are looking to the left to see what the market did last time. Simply based on what it did last time, we will know exactly how to react, okay? It is our job to be one with the market. So we have to understand what is it exactly that it's doing, okay? Once we understand, we simply read and react. We don't tell the market what to do, okay? Because the market is at the zone, it doesn't mean that it's going to sell. No. Once it gives you the price action that indicate sellers have taken over, you're just going to join the sellers. That's it. Sometimes you could join the sellers and then it goes against you, but it's okay. As long as you're doing what you're supposed to do, you should be just fine. Think of it like this. You know, every time you go to work, you clock in on time because you have a time to clock in, right? Sometimes you clock in and then 30 minutes in, then they send you home. Okay. Or you clock in, be like, hey, you was in schedule. We don't need you today. Okay. It's okay. But you did what you were supposed to do. Simply reading and reacting. Okay. So back to the chart. So in the case of this, market come to the area where this is the last bullish candle, right? And then they give us a bearish candle, but that bearish candle right here, right? This bearish candle did not engulf the last bullish. And then it turned around and give us another bullish candle, which is right here. But that bullish candle did not engulf the last bearish candle. It's everything's even out. Okay. So it's just consolidating, right? And then the third candle we give us is our bearish engulfing price action. Okay. Let's go yellow so you can stand out a bit more, right? So right here is where you would enter for the sell. That's your execution right there. That 4-hour bearish engulfing. Once you take that sell, same thing. We look to the left. Again, we are looking to the left to identify the previous low high or the previous high. Okay, so just so you understand, again, with the low high, so a downtrend market, especially one that gives you that break and retest, like so, right? I mean, when I say a break and retest that comes back up to match the previous lower high, giving you a double top. Okay, look, so lows, highs, lower low, lower high, lower low, lower highs. Okay, so let me mark these out for you so it makes more sense. Okay, let's just say this is the low, this is a lower low, and then a lower low. Why? Because it's getting lower and lower, right? Now, these are your low high. So let's just say high, right? This right here will be a low high. Okay. So we're going to generate a zone because the market stops here and went down, right? So we're just going to generate a zone. The market stops here, which is going to generate a zone. You see how it came back to retest it and it fell? So that's the same right here, same zone, but we adjusting accordingly, right? It stops here and went down, which is going to generate a zone, right? Also, it had stops here. We just also going to generate a zone, right? Just like the first one where it broke, it stops at the previous low point. So it broke that low, right? Come back to retest it and it fell. So it came back again, broke that low again, but this time it broke through it to go match the previous lower high. We are still in a downtrend because no lower high have been broken yet. So in the case of this, now we have two beam, like two pillars, right? Now we have a double top, right? So we look here to take our sell. So after that, once we take our sell with a bearish engulfing price action, we look to the left again, right? At our previous low high to place our stop loss. Okay. Now, in the case of this, let's just say we didn't have this right here. Let's just say the market was more of it was a bullish transition into a bearish. Okay. It was a bullish transition into a bearish, something like this, right? It was more of an uptrend market that's transitioned into a bearish. So now we have a triple top, right? Where it hit from the first stop, it stops, it goes to, this is the third, right? So we have a triple top. So we will take our sell here, and then we will still look to the left to place our stop loss. Now, these candles did not have an extended wick, right? So we could see as a, for stop loss placement, of course, we look to the left, and we do have that wick up here. So there was no wicks. Let's just say hypothetically, we had a wick that was this long, right? Due to the fact that this wick right here will be a lot higher, we would use that as a stop loss because it would have been higher than this right here. Now, since that's not the case, right? That is not the case. We are going to read and react, right? We're just going to look to the left. So once we take our trade, this is entry, right? We enter here for a sell, okay? We enter here for a sell, and then we look, after enter, we look to the left for our stop loss right up here, okay? But like maybe 3 to 5 pips above it or exactly on top. But as long as you're using the previous structure point for your stop loss, I believe you should be just fine. That, based on what I've studied and my success and those that I have taught, I guarantee you that I could guarantee you a 80 to 95%, 85 to 95% winning rate. That 5% is literally that times it doesn't go your way. Okay. But that's the way to trade. So just like so, we're going to go ahead and look at another one. Well, just like that, we're going to go ahead and look at another one now. Let's clear up real quick. All right, let me just run over it one more time. Okay. I'm going to do it a slightly bit slower, just in case if I was speaking too fast. Okay. Now, all right. So again, we have a market setup that's based off either a monthly time frame, the technical analysis itself, the daily, I'm sorry, weekly, or the daily. Okay. That's the time frame our setup is coming from. Okay. Now we drop down to the H4, right? For the 4 hour. That's what we're waiting for the price action at that same zone, the zone that was marked on a higher time frame. Okay. Now, when we go to the 4 hour, we see that the market is falling. It gives us a break and retest, right? We're gonna notice the structure that the market was giving us, lower lows, okay? Where each lower is lower than the previous one, and we got lower highs, okay? All right. Market stops here. It went up to give us the next low high. Now let's just say this is one leg. Okay, it went up and it stops here. Give us a one candle price action, bearish engulfing, and it fell. Right. We're gonna mark this area as our zone because that's where it stops at. Okay, we marking this area for when and if the market comes back to that same zone. We are going to anticipate. We're going to anticipate when it does give us the same setup so we could join the market, right? Now, the market comes back to the zone, right? So it sold and then it bought back up. At our zone, it consolidated for 1, 2, that's 12 hours, 1, 2, I'm sorry, 8, right? 8 hours, it's consolidated for 12 hours, okay? So 4 hour, right? That's the first 8, right? And then we got a whole 16, and then boom, we got a whole 24-hour, right? So we can also get another bearish engulfing that can be smaller with a wick or a doji, okay? It could sit there for 24 hours. It could sit there for 8 hours. It could sit there for 12 hours, right? It could sit there for a whole day, right? But our job is just to simply read and react, right? So we see that the market, that's the last 4 hour, boom. Okay. Now we're going to start waiting for a price action. Okay. First one we get is this bearish candle right here. It did not engulf. That's 4 hour later, right? Another 4 hour later, we got a bullish candle that did not engulf the last bearish, but it's still within the zone. So that's a whole 8 hours later. Okay. And then boom, we got the last candle right here, which is the red that give us that bearish engulfing. So that's literally a whole 12 hours later. Okay. We got a whole 12 hours later for us to take our sell. Okay. Now, the best thing about this is since we're taking a 4 hour time frame setup, right? Our time frame is literally 1, 5, or 9. So it's 4 hours in between. So you don't exactly have to sit there and watch it. Now, if you want to count the first candle that closed, yeah, you could say, yeah, cool. The market sat there for a whole 16 hours. Okay, cool. Another 4 hour again, it sat there for a whole 24 hours, well, 24 hour, right? But it doesn't matter if it sit there for 12. It doesn't matter if it sit there for 16. Okay. As long as the market give us the bearish engulfing that we are looking for, we're just going to take that for what it is. Sorry about that. So that's literally my alarm. So 8:55, literally 5 minutes before the 9 o'clock candle closed to tell me exactly if I have a bullish engulfing, if I have a bearish engulfing based on the setup or the time frame that I'm trading. Okay, so we have this double top right here with a bearish engulfing. We take our entry and we look to the left to place a stop loss because we're looking for the last high and we targeted the next structure low. Now, the structure low that we are targeting, there's nothing wrong with targeting the 4 hour structure low, but due to the fact that we're taking our trade either based off the daily or the weekly or even the monthly, we're gonna go to that specific time frame, daily, weekly, or monthly to target the actual TP based off that time frame. Get the bigger picture so you get in the swing of it, okay?